at SJS Markets Limited, who joins us now live from Hong Kong. We've just been talking about the challenges that are facing China. And I noticed one of your comments is that you expect China to depeg the yuan from the dollar in the second quarter. Tell us why you think that this is going to be the measure China will adopt.
I believe that the Chinese policymakers will pretty soon conclude that they should allow more renminbi appreciation after halting it for over a year. There are two reasons for that. First, the crisis is largely behind us, as we can see in strong growth in Chinese exports. Double-digit accelerating gains imply that there is no further need to shelter exporters from the currency market by holding a flat dollar-renminbi exchange rate. And second is the rising inflation, which I'm pretty sure will top the 3% target this year. Already in April will move above that threshold, and a stronger currency would be one of the policies that the central bank can use to limit gains in prices.
Just how inflationary do you think the environment is in China at the moment? Because we know the figures that came out yesterday were heavily influenced by the holiday period. So, you know, traditionally policymakers don't pay a lot of attention to the January-February numbers.
Chinese inflation currently is not a runaway sort of move in prices by any stretch of imagination. However, when you look at what's happening with domestic demand, it's pretty clear that it will push prices higher because imports, for instance, in the first 2 months of the year are up over 60% year on year. Fixed asset investments continue to rise by over 25% year on year. Real retail sales were up 16% year on year. So clearly demand pressures will push inflation higher, and I think it will be approaching about 5% by the summer. As a result, it's unavoidable that the central bank will have to continue raising the RRR ratio, and that they will start increasing the actual lending and deposit rates also sometime in the second quarter of this year.
Yeah, listen, Dariusz, you're a real polite, mild-mannered kind of guy, so I want to just make sure I have it right here and put this into context. What you're saying is Q2, China is going to let the RMB peg go. We're not talking about a gradual return to appreciation, 3%, 4%, 5%. You're saying, look, they're going to break that thing and just let it go. And if you believe, like a lot of people do, RMB is 20% undervalued, and you let the RMB find its own level, you're talking about an appreciation of that quantum?
Well, don't be fooled by the mild manners. I'm sure that the appreciation will not be that dramatic. Chinese policymakers never move in very large steps. They always are gradual. So what I'm anticipating is that they will allow renminbi to resume this gradual appreciation that we saw in years prior to mid-2008. By the end of this year, for instance, I think renminbi will be trading only 2% up versus the dollar from current levels at 6.69, and by the end of next year at 6.55. So by no means will they move a dramatic move. Partially because recent studies have shown that profit margins of Chinese exporters are so low that appreciation of more than 2.5% over 1 year would wipe out a lot of profits. So no, it will not be a harsh move. It will be a very slow, gradual appreciation.
I understand why they need to do it slowly as she goes, but if you're talking about breaking that peg, how are they going to control the pace or rate of appreciation of the RMB?
They will resume the controlling mechanism that they have been using prior to mid-2008, which basically means continued intervention to the point where the currency moves gradually higher. So it will not be very different from what they are doing now. They are intervening massively to basically keep the exchange rate to the dollar flat. The intervention size will maybe be lowered somewhat, but the central bank will continue to guide the exchange rates very closely, I believe. I also don't think that they will make any one-off revaluation before this gradual appreciation resumes, precisely because of what it would do to competitiveness of their exporters. So I don't see any fireworks there.
Dariusz, just in the remaining time while we have you, your call on the euro, certainly one that many in the markets are following, modest near-term upside to 140 within a month. What's behind that?
I believe that euro will continue to very gradually recover from the blow dealt to it by the Greek fiscal drama. As credit default swaps on Greek sovereign debt show decline in the cost of protection against default, the euro is gradually increasing because it has been so strongly correlated to this cost of protection. But markets are not convinced that everything will be all clear for Greece, and as a result, the euro does not have much upside. Besides, its role as a potential rival in terms of being another reserve currency rival to the dollar is now in doubt because we are not that sure about the cohesion of the Eurozone. So not much upside, 140 within a month. But then later this year, it's going to actually fall because I believe that the risk aversion will resume on concerns over double dip, and we will end 2010 at 1.32.
Important calls for those who are looking at investing at the moment. Thanks so much. Dariusz Kowalczyk is Chief Investment Strategist at SJS Markets Limited. Morning call.